Something unprecedented is happening in Treasury bond markets right now. This isn't normal market volatility or cyclical fluctuation. This represents systemic stress that could trigger the most violent precious metals rally in modern history. Long-term Treasury yields are breaking technical levels that haven't been breached in decades. The 30-year bond yield has risen above 5% for the first time since 2007. The 10-year yield is approaching similar levels with alarming velocity. These aren't gradual adjustments to changing economic conditions. These are panic moves that signal fundamental problems with debt sustainability and monetary credibility. The speed of yield increases has caught most institutional investors completely unprepared. Bond portfolios that appeared stable just months ago are experiencing losses typically associated with equity market crashes. Insurance companies and pension funds face margin calls and redemption pressures that force additional selling. When Treasury bonds lose the confidence of global investors, consequences cascade through every financial market. Bonds represent the foundation of the global monetary system. They serve as collateral for trillions in derivative contracts. They back pension funds, insurance companies, and banking reserves worldwide. The current Treasury bond sell-off represents more than interest rate adjustment. It represents a loss of confidence in the dollar system itself. International investors are questioning whether the United States can service its $38 trillion debt burden. They're questioning whether the dollar can maintain purchasing power when deficit spending exceeds $2 trillion annually. Foreign central banks have been net sellers of Treasury securities for 6 consecutive months. Japan, historically the largest foreign holder, has reduced positions by over $200 billion. China continues reducing exposure despite trade relationships that generate dollar surpluses. These aren't portfolio adjustments, but strategic retreats from dollar dependency. This loss of confidence creates liquidity pressures that force central bank intervention. The Federal Reserve cannot allow Treasury bond markets to collapse. They cannot allow yields to rise to levels that make debt service impossible. They must intervene with liquidity injections that debase the currency. But here's what most analysts miss about this dynamic. Central bank intervention that prevents bond market collapse simultaneously destroys currency credibility. The Fed saves the bond market by printing money, but printing money destroys the purchasing power that makes bonds attractive to international investors. The mathematics are becoming impossible to ignore. At current debt levels and interest rates, the U.S. government faces annual interest payments exceeding $1 trillion. This represents nearly 20% of total federal revenue. Any significant increase in rates makes debt service mathematically unsustainable without massive money printing. This creates a feedback loop that accelerates precious metals demand. Investors flee bonds because yields are too low for real inflation rates. They flee cash because currencies are being debased through money printing. They flee stocks because higher rates destroy valuations and corporate profitability. The only remaining alternative becomes physical assets with intrinsic value. Silver and gold benefit from this dynamic, but silver benefits exponentially more. Gold attracts institutional and central bank demand during currency crises, but silver attracts both monetary demand and industrial panic buying. When financial systems become unstable, industrial users hoard silver supplies as insurance against supply chain disruption. The industrial demand component makes silver uniquely explosive during crisis periods. Solar panel manufacturers, electronics companies, and defense contractors cannot risk supply disruptions during geopolitical tensions. They build inventory regardless of price when supply chains become threatened by financial instability or trade conflicts. Current industrial silver demand patterns show this hoarding behavior beginning. Defense contractors are securing multi-year supply agreements at premium prices. Solar manufacturers are building strategic inventories despite carrying costs. Electronics companies are extending supplier contracts with guaranteed delivery terms. Meanwhile, investment demand for silver accelerates as investors recognize its monetary properties. Silver has served as money for thousands of years across multiple civilizations. It maintains value when currencies collapse and bond markets fail. But unlike gold, silver remains affordable for individual investors seeking crisis protection. The mathematical relationship between silver supply and potential demand creates extreme price sensitivity. Annual silver production equals approximately 800 million ounces globally. Industrial consumption absorbs roughly 600 million ounces annually. Investment demand, during normal conditions, requires approximately 100 million ounces. This leaves minimal buffer for crisis-driven demand increases. The supply side faces additional constraints that amplify scarcity potential. Approximately 60% of silver production comes as a byproduct of copper, lead, and zinc mining. When base metal mines reduce production due to economic conditions, silver supply declines regardless of silver prices. Primary silver mines cannot compensate quickly enough to offset byproduct supply reductions. Current silver prices around $30 per ounce reflect normal market conditions. They don't reflect crisis demand from simultaneous monetary and industrial panic. Crisis conditions could drive silver prices to levels that seem impossible today, but become inevitable under extreme supply-demand imbalances. The $300 to $500 silver scenario isn't based on speculation or market manipulation. It's based on supply and demand mathematics during extreme conditions. If investment demand reaches crisis levels, while industrial users hoard supplies, available silver becomes scarce rapidly. Mathematical modeling suggests these price levels become inevitable rather than possible. Historical precedents support these extreme price scenarios. During the 1979-1980 crisis, silver prices increased from $6 to over $50. That represented nearly ninefold appreciation in 18 months. Current conditions suggest even more severe disruption potential due to much larger monetary base and industrial demand. The Hunt brothers situation in 1979-1980 involved market manipulation that distorted natural price discovery through massive futures positions and delivery demands. Current conditions don't involve manipulation. They involve fundamental supply-demand imbalances that market forces cannot resolve quickly through normal price adjustment mechanisms. Modern silver demand includes applications that didn't exist in 1979. Electric vehicle production requires significant silver content in batteries and electrical systems. Solar panel manufacturing consumes enormous quantities annually for electrical conductivity. 5G infrastructure development needs silver for electronic components and signal processing. Military applications continue expanding as electronic warfare capabilities advance. These industrial applications cannot easily substitute alternative materials when silver becomes scarce. Copper lacks silver's conductivity properties. Aluminum cannot handle high-frequency applications. Palladium costs significantly more and faces similar supply constraints. Silver remains irreplaceable for most critical applications. If Treasury bond panic accelerates and central banks respond with massive liquidity injections, precious metals could enter parabolic phases. Parabolic price movements don't follow normal technical analysis patterns. They represent panic buying that overwhelms all selling pressure and creates feedback loops where higher prices attract more buyers. During parabolic phases, silver typically outperforms gold by substantial margins. Gold moves steadily higher as institutional money seeks stability and wealth preservation. Silver moves explosively higher as both institutional and retail investors recognize its scarcity and dual-purpose nature. The combination creates feedback loops that drive prices beyond rational fundamental levels. The $500 silver target assumes extreme crisis conditions. It assumes Treasury bond markets lose international confidence completely. It assumes central banks respond with unlimited money printing to prevent debt default. It assumes industrial users panic about supply availability and begin hoarding regardless of cost. These conditions aren't guaranteed to occur, but they're becoming increasingly probable based on observable trends. Treasury bond fundamentals continue deteriorating as government debt expands faster than economic growth. Central bank balance sheets remain historically elevated despite recent reduction attempts. Industrial silver demand continues growing while mine production stagnates. Gold's potential movement to $8,000 reflects different dynamics than silver, but operates through similar monetary mechanisms. Gold responds primarily to central bank policies and international monetary system stress. When central banks print money aggressively to prevent system collapse, gold prices typically rise proportionally to money supply increases. Current gold prices, around $2,400, don't reflect the full impact of monetary expansion since 2008. Gold reached $850 in 1980 when the money supply was much smaller than current levels. Today, its money supply suggests gold prices should already exceed historical highs by substantial margins based purely on currency debasement. The $8,000 gold scenario assumes central banks abandon inflation fighting entirely. It assumes they prioritize preventing bond market collapse and debt default over currency stability. It assumes international investors lose confidence in all fiat currencies simultaneously and flee to physical monetary assets. Central bank gold purchases support higher price targets through demonstrated institutional demand. Central banks have been net buyers for 14 consecutive years. They've purchased over 800 tons annually in recent years. This represents approximately 25% of annual mine production being removed from markets permanently. Central bank buying patterns suggest they expect higher gold prices and reduced currency stability. They wouldn't accumulate gold aggressively if they expected prices to decline or fiat currencies to strengthen. Their buying represents institutional recognition that monetary systems face fundamental problems requiring hard asset protection. The timing of these extreme price movements depends on Treasury bond market developments and central bank response capabilities. If yields continue rising despite Federal Reserve intervention, crisis conditions accelerate rapidly. If yields stabilize through massive money printing, precious metals benefit from currency debasement and inflation expectations. Either scenario supports higher precious metals prices. Rising yields create financial system stress that drives safe haven demand from institutional investors. Money printing creates inflation expectations that make hard assets attractive relative to currency-denominated investments. The velocity of price movements during crisis periods typically surprises everyone, including professional analysts. Silver moved from $6 to $50 in 18 months during the last major crisis. Similar percentage moves from current levels would reach $300 rapidly if supply-demand imbalances reach crisis proportions. But parabolic moves don't last indefinitely. They represent temporary dislocations that eventually correct through market mechanisms or supply response. The key is recognizing when crisis conditions begin and positioning accordingly before price movements become obvious to mainstream investors. Current warning signals include Treasury yield curve behavior, central bank intervention patterns, and precious metals supply-demand indicators. These signals don't provide precise timing, but they indicate increasing probability of extreme events requiring defensive positioning. The Treasury yield curve has been inverted for over 18 months. This represents the longest inversion in recorded history. Every previous inversion of this duration has been followed by significant financial crisis within 12 to 18 months. The current inversion shows no signs of normalizing, despite Federal Reserve policy adjustments. Federal Reserve intervention in Treasury markets has increased substantially over recent months. They've purchased bonds during periods when private demand proved insufficient to absorb new issuance. This intervention represents acknowledgement that normal market mechanisms aren't functioning properly and require artificial support. Silver supply indicators show increasing stress across multiple metrics. Exchange warehouse inventories have declined steadily for 8 consecutive months. Premium levels for physical silver have expanded beyond normal ranges in most major markets. Delivery times from major dealers have increased significantly due to supply constraints. These supply indicators suggest physical silver markets are tightening, while paper markets remain relatively calm. This disconnect typically precedes explosive price movements when physical demand overwhelms available supplies and forces paper market repricing. Industrial silver demand continues growing despite economic uncertainty and higher interest rates. Solar installations are accelerating globally due to government mandates and climate policies. Electric vehicle production is expanding rapidly despite economic headwinds. Defense spending includes increasing electronic warfare capabilities that require substantial silver content. Meanwhile, silver mine production faces constraints that limit supply response to higher prices. Environmental regulations restrict new mine development and expansion of existing operations. Existing mines face declining ore grades and increasing costs that reduce profitability. Recycling provides some supply, but cannot match industrial consumption growth rates. The supply-demand imbalance becomes critical during crisis periods when investment demand accelerates alongside continued industrial demand. Normal market conditions can balance through gradual price adjustments over time. Crisis conditions create panic buying that overwhelms price discovery mechanisms and creates feedback loops. Central bank digital currency development adds another dimension to precious metals, demand that didn't exist during previous crises. CBDCs represent increased government control over monetary transactions. They enable surveillance and restriction of economic activity. Physical precious metals provide privacy and autonomy that digital currencies cannot offer. The combination of monetary system stress and increasing government control creates multiple reasons for precious metals ownership. Investors seek inflation protection, crisis insurance, and financial privacy simultaneously. These multiple demand drivers create more sustained bull markets than single-factor-driven rallies. International developments support precious metals demand through reduced dollar usage in global trade. BRICS nations are developing alternative payment systems that bypass dollar-denominated settlement. These systems reduce dollar dependency and increase demand for alternative monetary assets, including gold and silver. As dollar usage declines internationally, excess dollars return to domestic markets, creating inflationary pressure. This creates inflationary pressure that supports precious metals prices while undermining Treasury bond values. The feedback loop accelerates as international dollar rejection forces domestic inflation higher. The feedback loops between bond market stress, central bank intervention, currency debasement, and precious metals demand are accelerating. Each intervention to stabilize one market creates instability in others. This creates cascading effects that become increasingly difficult to control through traditional policy tools. Federal Reserve attempts to support bond markets through purchases require money creation that expands the monetary base. Money creation reduces dollar purchasing power and real returns on dollar-denominated assets. Reduced purchasing power makes dollar-denominated bonds less attractive to international investors seeking positive real returns. This dynamic forces increasingly aggressive intervention that becomes self-defeating over time. Each intervention reduces the effectiveness of future interventions while increasing the scale required to achieve similar stabilization effects. The endgame involves either allowing bond markets to collapse under their own weight or destroying currency credibility through unlimited money printing. Both outcomes support extreme precious metals, price appreciation as investors flee failing monetary systems. Risk factors that could delay or prevent extreme price scenarios include successful inflation control without triggering recession, international cooperation to support dollar dominance, or technological solutions that reduce industrial silver demand. These risk factors appear increasingly unlikely given current trends and structural imbalances. Inflation control requires maintaining high interest rates that threaten bond market stability and debt sustainability. International cooperation faces challenges from competing national interests and declining U.S. economic dominance. Technological substitution faces physical limitations of alternative materials in critical applications. The probability of extreme precious metals price movements continues increasing as traditional stabilization mechanisms prove inadequate for current imbalances. Treasury bond panic represents the beginning rather than the end of this process. Investors who recognize these dynamics early have opportunities to position before crisis conditions become obvious to mainstream media and general public. But positioning requires understanding that extreme scenarios aren't speculation, but mathematical probability based on fundamental imbalances. The $300 to $500 silver scenario and $8,000 gold scenario reflect what happens when decades of monetary distortion reach breaking points. These breaking points approach as Treasury bond panic accelerates and central bank intervention proves counterproductive. Understanding these dynamics doesn't require predicting exact timing or prices. It requires recognizing that current monetary arrangements face fundamental challenges that traditional policy tools cannot resolve without creating greater problems. The Treasury bond panic has begun. Central bank responses are becoming counterproductive. Precious metals markets are preparing for the most violent bull market in modern history. The only question is whether investors will recognize the opportunity before it becomes obvious to everyone.